Well, hello, and welcome back to Principles of Macroeconomics. I'm your host, Dr. B. Today, we're going to be talking about finance tools as it relates to macroeconomics. And when we talk about finance tools, we're primarily talking about how money works when we invest money, when we invest cash, when we use cash, how much to save, all of those kinds of things. We're going to talk about today. And before we get started, I just want to touch on couple of key things in the classroom. We are, believe it or not, we're in week 10 already. I don't know where the time goes, but somehow we managed to get into week 10. We're in module 3. There are two chapters we'll be covering today, 14 and 15. 14 talks about finance, and 15 we're going to be talking about unemployment and how all those rates are calculated. And I'll try to make everything as relatable as possible. Last week we covered chapters 12 and 13. This week is 14, 15. Next week is 16, then 17, and then we're moving right along. The time is really flowing by. So as always, all of your work is always due on Sunday night of each respective week. So for this week, you'll have the Chapter 14 quiz, Chapter 15 homework, both due Sunday night. And as a friendly reminder, all quizzes and homework assignments, you can take those up to 2 times. So if you're not satisfied with your grade that you've received on either a homework assignment or a quiz, and you haven't taken it that second time, please feel free to do so in order to gain that higher score. Okay, let's go ahead and jump on in. So the first chapter we're going to talk about today is about finance tools. And what do we mean by that? We'll be talking about cash, when you save it, when you spend it, especially when you save it, or you invest it for that matter. One of the primary things we talk about with cash is when you're investing it, you tend to receive this thing called interest over time. Interest is when money earns money. That's what interest is. Money earns money. How does money earn money? You invest money into a savings account or into a retirement account or into some other type of investment vehicle like a certificate of deposit, something along those lines. You'll earn what we call interest. And what interest is it's your initial investment, known as the principal balance, earning additional money from that investment. So if you think about interest, think about it as a return on your investment. So how does it relate to economics, you might be wondering? Well, as you know, money is used to run a business. We use cash for pretty much everything. We use it to buy property, plant, and equipment. We use it to make investments into the business, to grow the business. We use it to purchase inventory. We use it to produce products. Right, yeah. So money makes the world go round is what the saying is. And that couldn't be more true because we really do use money for everything, to allocate resources over time. And we also use cash money as a way to mitigate risk. What do I mean by that? The word risk means that there is some type of endangerment involved, right? Or the risk of something happening. For example, in 2008, there was a risk of financial collapse due to banks lending to individuals at rates they shouldn't have been lending at, to people who shouldn't have been able to borrow in the first place. We call it subprime. Yeah, there was a prime market collapse. And there was a risk in 2008 with that. And so that financial collapse led to a housing collapse, which ultimately led to a dramatic economic downturn. How do we mitigate something like that from happening ever again? Well, there's a couple of investments that we make. One is into the banks. The banks have enough cash reserves on hand in order to mitigate that risk from happening again. And the other is, instead of investing all of our cash into one place, like in housing, we diversify our funds. Now, what a lot of your investments that you might have now might involve retirement savings, an actual savings account at a bank, or a mix of both, or maybe you have a house or a savings account, retirement account, etc. You're in that case we say you're diversified because all of your investments are spread across, right? And by doing that, you're mitigating your risk. You're not putting all your eggs in one basket. What happens when you put all your eggs in one basket is if that basket falls, all your eggs break, right? So it's good to have your eggs in multiple baskets. So that way, if one basket falls and it breaks, the other ones don't fall as well. That's the idea of diversifying. Uh, so, how do we figure out how much interest we would make on those investments? Into retirement, into the savings account, etc. We use this formula. It's called present value. Present value. It's a financial formula. Uh, it's called present value. And what the present value tells us is the amount of money today, what we would need in order to generate an amount in the future using the current interest rates. Call it present value. So how much would I need to invest today in order to generate $200 in a year from today or 2 years from today at a X% interest rate? That's the idea of present value. There's another formula that we'll talk about, and it's called future value. So we have present value and we have future value. Future value tells us the amount of money that we would generate in the future. It's based off a series of cash flows, and the amount is of the money that we would need today, that we would put into the bank today in order to generate X amount of dollars in the future, given the current interest rate. So it's present value, future value, payment amount, interest rate, number of periods. These are all components that build the present value formula, the future value formula, the net present value formula. All these formulas, what's the purpose of them? Why do we need to know this stuff, Dr. B? You might be asking. The reason why you would want to know the present value or the future value is to understand how much you would need to invest today in order to generate future returns. Why is this important? Well, if you ever want to retire and you want to have an income in retirement through your 401k, Social Security, etc., you would need to know those formulas because you need to know how much money you should be putting in every month at your current age, so that way you'll be stable when it comes to retirement age. That's why it's important to know present value and future value. And then there's this other thing called compounding. This is where interest earns interest. Compounding. You've probably heard this term before, compounding. There's a compounding interest rate. Compounding simply means that we leave the interest in the bank untouched, and that interest will earn interest. So you have your principal plus interest, and you leave it in for a year. That amount will earn additional interest, and you leave that in for a year, and then that amount earns interest, and then you leave that in for a year, etc. You see where we're going with this. Yeah, it's compounding. It's where interest is earning interest over time. So here's an example of how we would use present value. Now, just a quick note here. There are a lot of financial calculators out on the internet that you can find. And most of you have this thing called a smartphone in your pocket, and you can actually use that as well. There is a finance function on most calculators. Uh, Actually, let me see if I think of my. Hold on just a sec. Let me see if I could get my camera on. Okay, yep, there we go. So for those of you who can see my camera, I'm holding a financial calculator. This financial calculator is called a BA2 Plus. It's made by Texas Instruments. It's a financial calculator. That's all it does. Okay. Yeah, I know I'm old fashioned. What can I tell you? But okay, so I have this old fashioned calculator here. It's not too old fashioned. I use it. I use it frequently, actually. And so what this does is it will compute present value, future value, uh, payment amounts, all of those really good things, right? And so on the second and third rows are the buttons that I would typically use uh, for finding present value, future value, um, net present value, internal rate of return, cash flow calculations. These calculators are great for all that stuff, and you could find these on Amazon. You could find free calculators online, and so when it comes to like the homework assignment for this chapter, using one of those calculators absolutely fine. In fact, I recommend it. But the idea of these formulas that we're talking about, we call these the time value of money formulas. Time value of money. And what it does is represents how much money is worth over time. That's the whole idea. So, like, for example, here we have a present value example. If I were to put $100 in the bank today, how much will it be in n number of years? Excellent question. And you could easily find that out. How is that? Well, what is the number of years, and what is the current interest rate? Once you know what the interest rate is, and you know how long you want to leave that amount in the bank for, you can run out the present value formula by plugging in PV, which is 100, the interest rate, which is whatever the interest rate is, and the number of years that you're looking at. So let's say it's 5 years. You punch in 5, and it'll generate how much that amount would be after 5 years, which is very useful, because what that does is it shows you how that interest compounds over time. So that's working forward, right? So like if you put the money in today, how much is it worth 5 years from now? You could also work backward. What if you have a goal in mind and you're like, I really want to make sure that I have $1,000 in 2 years from now. Okay, great. So that's your goal. That's your future value, right? So you want to have that amount in 2 years from now. What would the interest rate need to be? And you can find the present value, which is how much you would need to put in the bank in order to get to that $1,000 in 2 years. That's the usefulness, right, of present and future value. So here's another example. How much would you need to deposit in the bank right now in order to have $200 in the bank in 2 years from now? So great, or a number of years, right? So n is the amount of time in periods. R is always the interest rate. So the future value is, I'm sorry. So to find how much I would need to put in the bank today, which is present value, I would put future value, in this case 200, divided by 1 plus the interest rate to the power of the number of years. And that is formula for present value. It's future value divided by 1 plus the interest rate to the power of the number of years. If you don't know what the future value is, you can always put it in an estimation. But oftentimes, to find the future value amount, we run out the present value formula. So yeah, it's useful. It really is, and this information can really help you when it comes to planning for investing. It tells you how much you should be putting in each year in order to generate X amount in so many years outward, and that really is helpful when it comes to retiring, things like that. So that's my little spiel on the on the present value. And we can always find the present value for a future amount of money through the process of discounting. So how do we discount? Or what is the general formula for the present value? R represents the interest rate. X amounts the amount that we want to have received in the number of years in the future. So the formula is X, which is the future value, divided by 1 plus the interest rate to the power of the number of years. And that's the present value formula. And the cool thing is you could run that out, with really any amounts. It's interesting. It's a fun way to find out how much you would need to invest now in order to generate so much in the future. What about risk? As you know, there's risk with any investment that we make, regardless of what is happening. Risk is something that happens, right? We're always taking a risk. What they say is when you do investing, is that you could possibly lose up to the value of your investment, right? And that's so true. Like, so for some of you, I know that some of you like to play the single stock market game. Not me. I don't play that game, but I'm just saying. I know some students, they like to play the single stock markets. They'll make like investments using their Fidelity account or Ameritrade or whatever, right? Or you're interested in that Bitcoin stuff, or that digital currency trends. There's major risk with those types of investments, and the risk is you could lose up to your investment, right? Because why is that a risk? What if the market crashes and it goes to zero? Okay, yeah, that's happened, absolutely. So these are risks that we take with investing. So anytime you make an investment, there's inherent risk involved. So it's important to take any type of risk into account before you make an investment decision. It's super important. I personally, I'm a risk adverse kind of person. I don't like risk. I don't like taking risky moves. Sometimes I do. It depends in what it is, right? But mostly I'm risk adverse, which means I don't like uncertainty. Uncertainty is not a good feeling. I don't like to feel uncertain about anything, really. Um, you know, the idea of uncertainty kind of scares me sometimes. It's like, oh, I don't know what's going to happen in a few months from now. No one really does, but that uncertainty, I don't like it. I don't like to feel uncertain. So that's what being risk adverse means. And when you're investing, you have to know yourself and to know what your risk tolerance is, how much risk you're willing to take on. And that comes along the lines with having what we call utility, and that's you being subjective and being satisfied in the investments that you're making. And so it's really important for you to understand what your risk tolerance levels are, what your utility is, before making investment decisions, before investing into things like stocks and bonds and whatever, right? It's just really really important for you to understand that. Uh, and there's this concept called diminishing utility. When something's diminishing, it means that it's going less, right? That's what diminishing means. But it said that a person who is wealthy has diminishing utility from additional uh, wealth. Why is that? There's less usefulness with additional wealth if you're already wealthy. Makes sense. And so this is kind of what this represents. So this is the utility curve. The utility curve shows us the level of satisfaction with wealth over time. It's with that old saying, you always want more until you have enough. So it's like, yeah, I want more wealth. I want more wealth. I want more wealth. At some point, you're going to say, okay, I'm satisfied. We hope, right? Hopefully you say that. But yeah, you say, I'm satisfied. And so at that point, your utility goes down. Once you're satisfied with the wealth that you're getting over time, your utility goes down. Why is that? Because you no longer care. You're wealthy. And that's basically what this shows us. We see that winning and losing is a lot when utility's high when it's early on the curve, right? Because that shows us the level of satisfaction. The level of utility is high early on. But once you reach a certain point, for example, winning $1,000 or gaining $1,000 over time, we see that you become more satisfied. Past a certain point, and then you no longer care so much about the wealth, and so then it becomes a diminishing utility. Insurance. So we talked a lot about investments. We talked about present value, future value, compounding interest. There's a reason why we have insurance. Those investments we just talked about, people like to get insurance policies on pretty much anything. Life insurance, car insurance, house insurance, pet insurance. I'm sure there's a lot of other ones, right? But the idea, why do people buy insurance? It's a way to mitigate risk. You don't want to lose everything. So how do you not lose everything? You get insurance. House burns down. Did you just lose all that money you put in the house? Well, no. How's that? Insurance. Right? Car accident, car got totaled. Did you lose your investment into the car? No. Why? Insurance. Yeah, insurance. Very important to get insurance. It helps to mitigate risk. Insurance company accepts all or part of the risk. It's usually part. Okay. And a lot of that depends on the premium that you're paying. There are insurance contracts that help you to face the risk, to protect you. You pay a premium for that protection. It gives you peace of mind. The idea of the insurance company is to be there in the event of something happening, right? That's why we get insurance. That's why it's like, oh, you got into a fender bender the other weekend? Well, thank God you had insurance. Oh, you got into an accident, you got hurt? It's a good thing you got health insurance. Oh, it's, whatever, right? The idea of the insurance is that it helps you in the event of something happening, right? It doesn't eliminate the risk. The risk is always going to be there. It helps to spread the risk in order for you to take the blow a little bit easier, Okay, that's what insurance is there for. And you hope you never have to use it, but it's important that you have the insurance. Adverse selection: high risk people are more likely to pay more for insurance. That's obvious. If you had 5 accidents in the past, your insurance premium is going to be really high. It's because you're accident prone. Okay. Uh, People who buy insurance are less. There's less incentive to be careful. I don't know about that. I'm actually more careful because I don't want to pay more. Insurance companies are not perfect, obviously. There are high and low risk customers that insurance companies have. So what do? They try to spread that risk, but they also try their best to control or not control, but monitor their high risk customers and their behaviors. That's why, like, if you smoke cigarettes, your health insurance premiums will be higher than those who do not smoke cigarettes. Why? Cigarettes cause people to get cancer and die. So, uh, if you don't smoke, there's a less chance, you're at lower risk, right, of getting the lung cancer and dying. Uh, the risk, of course, is still there, but it's a lot lower than somebody who smokes, right? So somebody who smokes, they pay more for their health insurance. Somebody who does not smoke, less for their health insurance. It makes perfect sense because smoking is a risky behavior. Same with alcohol consumption. It's the same with driving habits. So we have car insurance. If you're a risky driver or you have a young person at home who's driving, age 16, 17, 18, they tend to be a little bit more riskier than the older folks who are driving. Because of it, the insurance premiums are higher for younger drivers. And so all of those risks are what drive insurance premiums. How they factor how much you pay a month. That's how they factor it. It's based off of all of those things, right? I had mentioned the term earlier, diversification. You diversify your investments. Don't put all your eggs in one basket. That's why you don't want to just invest in the housing or the housing market, because if the housing market collapses, you lose your investment. If you don't want to invest just in the individual stocks, because if those stocks go down, you lose your investment. So you want to make sure you diversify your investments. Smaller eggs in the bigger baskets, okay? Multiple baskets. You don't want to be all your investments into one place. That's too risky. You want to diversify. And we use standard deviation, which is hopefully you all took a statistics class. If you haven't already, hopefully you're in it right now. But this concept of standard deviation measures the volatility of a variable. That's what standard deviation means, right? Hopefully you remember that from your statistics class. So a lot of you, hopefully you have a retirement plan. If not, get one. Get an IRA, individual retirement plan, IRA. 401k, 403b, 403c. So there's the government ones, FSA, whatever. The list goes on and on. Your retirement plans, regardless of which one you have, even if it's a pension, has stocks and bonds and mutual funds and maybe real estate. Trust me, it's in there. They're all in there. The riskiness of that depends on how well it's diversified. So what I do at the pretty much every year is I look at my retirement accounts and I recalibrate them based off of how I feel, and based off of the performance, of course. And the number of stocks, or the riskiness of your stocks depends on the stocks that are in that portfolio. If the standard deviation is high for that portfolio, that means it's risky. So you typically want it to be a medium or low, right? You don't want a lot. If you're younger, it's okay to have a little bit more risk in your portfolio. But if you're toward retirement age, or you're middle late age toward retirement age, you don't want it to be risky, right? Because you want something to be there when you retire. And this is what this kind of shows us, right? And this is a lot of this depends on your risk tolerance. But you see, the more stocks you have in your portfolio, in your retirement account, the more stocks you have, the more diversified you are, the lower the risk is. Higher diversification means lower risk. That's all this is telling us. Higher diversification means lower risk. Diversifying will not eliminate risk. It cannot eliminate market risk. It's impossible. But it will lower the risk. It can never eliminate it. Risk will always be there. It's inherent. But it will be lower through diversification. I never do single stock investments. I really don't. I never do. Why is that? Because if the stock for that one company goes down, you can lose a lot of money. So that's why I don't do it. Not even if it's a sure thing, because there's no such thing as a sure thing. Market risk affects all companies. It's that are publicly traded. That's how life works. There are two types of assets: diversified group and a safe alternative. Okay, there are some investments that will go up and there's very little risk, and what those are, certificate of deposit, CD. That's the only thing that really won't go negative. Might go zero, but it won't go negative. Diversified group will get you between 8 and 20% returns. A return is the return on your investment, right? That's what a return is. So your retirement accounts, 8% to 20% is the norm. It usually hovers around 8% to 12% thereabouts. 20 is high, in my opinion. 0 to 3%, those are like your safe investments, your CDs, your bonds. CDs and bonds, they usually have lower returns. But stocks typically have between 8 and 20%. That's about right. The trade-off is that with the lower the risk, the lower the return. So that's why, like, when you're younger, it's okay to be risky in terms of your stock investments. But when you're older, it's not so much that good, right? Because the higher the risk, the greater the return. But the higher the risk means you could lose more. So we don't want that to happen. And this shows us the standard deviation over time. So the more you have invested into stocks for longer periods of time, the higher the standard deviation is, higher the risk is. So what do you do when you're looking at different stocks, and what do you want to invest in, and things like that? Well, you take a look at the companies that you're looking to invest in. Read their 10K reports. Look at their strategies for growth. Determine their actual value. You really need to do all those things before you make any type of investment. Very, very important that you do your homework, as they say. Stocks with greater value, or what we call, that have greater value than their actual price, is called undervalued. Overvalued is where the value is less than the actual price stated. And if it's a fair value, that means that it's fairly priced. And what determines the stock price, you might be asking? Well, it goes up and down, and it's based off of a number of factors: amount of trade, the amount of net income the company brings in every quarter. There's a lot of factors that go into determining stock price. The number of shares outstanding, all of those are factors. So do all your own research. Wall Street analysts, they usually got good advice. I typically buy mutual funds. A mutual fund is a fund that has a lot of different stocks in it. It's a large stock portfolio, and mutual funds really help to diversify your risk. And so, my advice is to definitely talk to an investment professional. A retirement professional, investment professional. Very important to get their advice. Oftentimes, it's free advice. Never paid for never pay for advice. Just don't do that. That's silly. Uh, Never make judgments on the stocks. I'll tell you this: the stock will go up and down. You don't want to just rely on value of assets, but you want to take those into consideration when you're making investment decisions. Companies listed on a major stock exchange like the Nasdaq or the S&P 500 or the New York Stock Exchange, followed closely by money managers, and they typically tend to make good decisions. There's a couple that don't. And of course, equilibrium of supply and demand typically sets the market price, just like anything else. The stocks work the same way: supply and demand, supply and demand. Stock markets are informational when it comes to efficiencies, where the asset prices describe the stock prices. They're relatively efficient with respect to the information. And this one's important. The stock prices should follow a random walk. It's where the changes in the stock prices are impossible to predict available information. What does that mean? The stock price is going to go up and down regardless of what the actual information tells us. Just the other day, I saw a company that had a great day for sales. Their sales were through the roof, beat estimates by everyone's expectations. Stock price fell. Don't know why. It doesn't make any sense. But that's the market. So we always look at what people are willing to buy or to sell and make sure that the stocks are rational. And it's oftentimes the changes in stock prices are partly psychological. Like we all saw what happened to the GameStop stock. We all saw what happened to the AMC movie theater stock. A lot of that's psychological. People invest in things because they like them. Like I invested in Starbucks because I like Starbucks. I think it's a good company. I believe in their mission. There's a lot of reasons why people invest, and it's mostly psychological. Speculation is dangerous. When somebody says something speculative, I stay away from it because speculation is usually very high risk. And so sometimes they get into what they call a bubble. A stock bubble is when the value goes really high for no real reason, and then eventually it bursts, right? And then the value plummets. That's what we call a bubble. You have like a bubble gum bubble, right? Yep, eventually it pops. And some people invest into various companies because they want they want a dividend. A dividend is a payment to the stockholders from the company for their investment into the stock. Some people invest in only companies that pay dividends. I personally don't. I like all different kinds of companies. And you just have to take into consideration that the market sometimes is very irrational. Stock prices go up and down for no reason, or for a reason that's solely based off of news events, which are irrational changes. And oftentimes the market will eventually correct itself, but it's impossible to know when something like that would happen. That, my friends, is the conclusion of chapter 14, which is the basic tools of finance. Any questions on stock investments or savings returns or CDs or any type of investments that you're interested in talking about? Are you all okay?
I'm good, Professor.
Thanks, Jazz. Appreciate you. Rest of y'all all right? Okay. Well, if you ever want to talk about like investments or you have questions about investing, oh, should I buy this stock? Oh, should I uh, buy this bond? Oh, should I invest in this CD? Oh, should I buy this house? Feel free to ask me. Okay. My advice is always free to you all. But yeah, feel free to ask. Um, anyway, if there are no questions on the chapter, I'll stop this recording and we'll start the next one for chapter 15. So please stand by. Hold on just a sec. We'll stop this one.